setting up the specific type of life insurance that banks use, that institutions use, called overfunded whole life insurance, allows you to boost your returns by 400, 800%. It allows you to have asset protection on that money.
Dale Clark, the Human ATM, is going to teach you about cash flow banking. This has been my framework that I unintentionally started to a certain degree at age 19, and it has never failed me. It's been the way that I've capitalized buying a company, putting in a TV studio, paying off high interest rate loans, funding my first New York Times bestseller, and then it's a place that I can go store it again that I've earned around 5% without having to pay tax. So it's outperforming my savings account because it's the same thing the banks do when you put money in theirs. They take a percentage and then they just put it in the same place. Why not cut out the middleman so that you can get those returns and that you can have that safety? So Dale, tell us how we do it.
So cash flow banking is just a more elegant, simple system to help you not only capture wealth, but also, create wealth. Mm-hmm. And so, you
get a wealth capture account, which is a savings account.
Right.
Pay yourself first into that. That starts to build up. But instead of leaving that taxable and exposed,
right,
we're just going to have it automatically move to another account.
You have the opportunity to put that in a different account, and the account makes 400 to 800% higher rate of return than you might be getting in a savings account. We use a very specific type of product called a whole life insurance policy. It's a permanent life insurance policy.
Now, 90% of them aren't designed properly. They're not going to work. They're going to be too slow. It's got to be designed properly. Let's talk about that.
Right, and talking about improper design, before I even met you, Garrett, my dad set up a policy on me. It was I think it was a universal life policy, variable universal life. And after about owning it for a couple of years, he handed it over to me. I got married. I moved to Michigan, and he's like, "Hey, Dale, here's this present for you." And being young and naive, I didn't know what to do with this, and so I'm like, well, this is a perfect thing to buy myself a big screen TV. And so I cashed it out, and I bought a big screen TV, and you would not believe how mad my dad was, because he had been saving for years and years in this.
He's like working so hard for you to have this big
What
screen
are you
TV.
Doing, right? So that's not the right way to do that. I was being a spender in that moment right there. But yeah, setting up the specific type of life insurance that banks use, that institutions use, called overfunded whole life insurance, allows you to boost your returns by 400, 800%. It allows you to have asset protection on that money. It allows you to have flexibility so that you can contribute more or less depending on certain situations that you're in.
This is how it's designed to make it
Correct.
work
This
that
is how
way.
it's designed.
And you can access that money
Correct.
before 59 and a half. There's no penalty.
You can.
There's multiple ways to access that money.
Correct. So there's a couple different strategies to access the money. One of which is the flat-out withdrawal. And it's not a strategy that we typically recommend, but if you ever wanted to go and take money out of a policy and never put it back in, you could withdraw the money. The downside to it is it could be a taxable event.
Yeah.
Any money going into it above the basis becomes taxable.
Yeah.
And you can't put the money back in with a withdrawal.
Look, I actually wrote a book on this, and if you're going to want to just click where the arrow is and grab this book for free. Now, you'll pay the shipping and handling, but it's minimal, like very minuscule amount, but I'll cover the cost of the book so that if you want to dive into this, we're going to talk about it here, but if you want more information on it, because this is going to be maybe 10 or so minutes on it, that will give you kind of like your own pacing.
Right. So the other way to access the cash in the account is through taking out a policy loan. And when you take out a loan, you're not actually borrowing your own money. You're borrowing money from the insurance company.
And your money's collateral.
And your money is collateralized. Collateralized.
So it doesn't matter your credit score. It just matters how much cash is in the policy. You
don't have to go through a loan application. There's no credit check.
No payback period that's firm that you have to do either.
Correct. Right? Yeah. Exactly. So and the money that when you take out a loan, there's no taxes on the loan. There's no penalties. Now there are situations where it could be taxable on the loan. If you step above a guideline called the modified endowment contract, where
so
you're
you just
overfunding.
Put so much overfunding beyond what the government really wants you to be.
And people used to do that back in the 80s and 90s, where they
and
just
it didn't matter back then.
Yeah, they could put in $1 million and have it grow all tax deferred and really loaning it out tax free.
And the rules changed a little bit because it was a bit abusive.
Right.
So we're talking about instead of having money in a savings account, cut out the middleman of the bank, put where they put some of their reserves, which is this overfunded higher cash value life insurance that once it earns interest, it's locked in, has a minimum guaranteed. It has, depending on the state you're in, 100% liability protection or partial liability protection in bankruptcy or lawsuit. And it's available or accessible either because you just take a withdrawal or you get a loan and that you could always pay that back on your own terms, or if you die, the death benefit will tax-free pay it back.
And let's talk about that for a second, because typically when you think of a loan, it's a 4-letter word. But the reality is that when you take out a loan against your life insurance policy, it's an unstructured loan, meaning you have full, control over when you pay it back,
terms.
Or you may not even decide to pay it back. In fact,
when you borrow, don't you set up a schedule?
So I usually set up a schedule where, if I borrow out $100,000, I'll just do an amortization over 5 years and pay back a certain amount of dollars every month.
We're all like, just go, I just sold the cabin. Let's go ahead and put some money back in the cash values from borrowing to buy the other cabin.
Right.
I'm more just like when there's a windfall of money, you're more of a structured way of doing it. Money personality.
Do whatever works for you, though.
Yeah.
But yeah, that's the really nice thing about this, is because there's no structure to the loan. It can be dangerous if you don't repay the loan. If you end up using all the cash value, and then the policy will require another premium, it could collapse on you. And so it's important that you stay above a certain threshold. Typically, you can borrow up to 95% of your cash value in the account. So if there's $100,000, you can have access to about 95. But the other 5% you got to leave in there just to make sure that the policy doesn't.
Well, if interest rates change, or the economy, or there's a major opportunity.
Right.
See, where opportunity really comes is when people are focused so heavily on their net worth and trying to build it and neglecting cash flow, they eventually, when there's a tough economy, have to cash out that net worth or that asset to cover their cash, and they have to sell it at a discount. Well, you could actually pull your cash value out because it's not going to go down during a downturn, and capitalize on that. So I've done that. I bought Remnant Rate, it was full page ads in New York Times and Wall Street Journal for killing sacred cows at a major discount, because because of the timing and through that remnant. So that was an example. Or in 2014, there's an opportunity to buy a business that was in distress that actually increased capabilities of my main business. So I was able to pull that cash value out, pay it back when I wanted to. I was able to negotiate a better price on this newest cabin that I bought because I could pay the cash out of the policy. So I look at it as, if I don't touch it for years, no problem, because it's just the opportunities aren't right, but I'm still getting a good return through my dividends. But if there is an opportunity, it's there. Well, it's just a much better place to store money. Just a better
place. And let me be clear about this. Cash flow banking is not the name of the life insurance policy. It's an overfunded. It's the whole system, and so the system includes finding and fixing your money leaks, understanding your money personality, setting up your proper account structure, having living wealthy and wealth capture accounts. So it's the whole system that allows you to be more elegant and have more control over your finances. The vehicle that we use in this particular strategy is called whole life insurance.
Right, and there's a lot of negative information about whole life, and I think a lot of it's merited because it's either not designed well, it's high commission the way it is, it takes forever to get cash, it's with the wrong companies, or just a lot of people not understanding what's going on, because there's something called price, cost, and value. Price is what we pay, it's the price tag. Cost is the economic impact. So something can have a high price and a low cost. Like the right accountant is the best example. They might save you way more tax even though you pay twice as much than another accountant, but it saves you 10 times more in tax. And then value is our overall fulfillment, joy, perspective, that we personally get from it. So when I think about it, yes, whole life is going to have a higher price tag than term insurance, but we're not looking at something that's just going to be temporary and go away. We're looking at something that's going to be permanent, and it creates a funding structure for cash value.
Correct, right. I mean, you can travel from Utah to New York on a bike, and it's going to be a lot cheaper to buy that bike than buy a nice first-class plane ticket, but it's going to take you a whole heck of a lot more time to get to New York. And so price and value are two different things.
Yeah. So any other sentiments or statements around cash flow banking?
So I would just say that this is a tool that you want to consider as part of your financial plan. This is not the only piece of it. We highly recommend that you are your best investment, that you invest in yourself and your business. But when you make a lot of money, you got to have a place to store that cash. There's got to be
a way to take business wealth and make it personal wealth. It's something that whether you're a business owner or whether you're a college student or whether you're me at 19 years old can start. I started at $50 a month.
Oh my gosh.
And you want to know the best companies to choose to set up something called cash flow banking, then pay close attention. First, when you put your money in that bank, they take a portion of that money and they put it in a reserve account. Part of the reserve account can be put in an insurance contract. This insurance contract is nothing like most life insurance policies. It has to be set up properly for you to minimize the costs, right? Have to lower the commissions and mimic, in your situation, what the banks are doing. Unfortunately, way too many of these policies are just really high commission and really low cash. It has to be the type of company that performs properly. There has to be very high early cash value, great dividends, a good guaranteed interest rate, and plenty of flexibility. These factors narrow down from thousands and thousands of companies to maybe a couple dozen. I'll unveil which companies to choose, which ones I certify, and personally create content for. All right. I'm going to let you ask the question, Chief of Staff Stola.
Okay, let's dive in. It comes in from Justin today. And he says, I'm wondering what insurance company that you recommend going through for whole term policies and what your relationship to Garda Insurance is. I've heard you say that there are a lot of insurance companies out there that offer security through a long history, maybe over 100 years. So what is there to worry about with younger companies? And are their planned death benefits still guaranteed if they go out of business?
Younger companies are like really young kids. Like I took my 15-year-old to start working with him on driving. And I mean, when you just put someone behind a wheel for the first time, it's a scary thing. So that's one thing about the younger companies. There's a lot more to it. But let me address this really directly. First, there's a lot of criteria on choosing great companies. That first one is that they're at least 100 years old. I'd like to see that because I want to see what happens during good times and bad times, recessions and depressions. And, we've seen world wars during that time. So I think that's really important to see when interest rates are high, low, the market's up or down. How do they handle that? The minimum guaranteed interest rate I look for is 4% because, I want to make sure that if things don't go according to plan, which a lot of times they don't, there's something you can count on. But I also want companies that always have paid a dividend throughout their entire existence because that means that they were able to pay even when everything else wasn't working out. And there's something in these types of policies called paid up additions, PUA. Paid up additions are where you're putting in extra cash above the base of the policy and it fuels more cash value and can even increase your death benefit. I want it to be flexible where you could put some money in and then another month maybe put more money in or another month put nothing in because I know that cash flow isn't always predictable. And we've seen, especially during recessions of 2000 to 2002, 2008 to 2010, and even what we're facing right now in 2020, that flexibility can be instrumental to make it to the other side. So I also prefer mutual companies over stock companies. And a mutual company is owned by the policyholders. Where a stock company is just like it sounds, it's on the stock market. So if they have earnings or they have dividends, they're going to give the policyholders some of that, but they're also going to give stockholders some of that. And if you've watched any of my other videos, I'm not really big on stock market companies because there's something called shareholder value. And I feel like a lot of times shareholder value takes such a huge priority because it's a fiduciary responsibility, meaning that's what they have to look out for, that many times they're not thinking about employees or customers. And, we've seen a lot of just terrible things happen in the public market. So I prefer a mutual company as well. So hopefully you get enhanced or better dividends. So that's the very first part on choosing a company as far as criteria.
Yes.
Now I could even list some of the companies.
So one of the points that you said was a minimum guarantee of 4%. How does one determine that that's
It's contractual.
Okay.
It's in the contract.
Okay. But
So-
are there fees that they need to look for in those plans just like they do 401ks? And how do they determine in the end they're actually going to get the 4%?
That's a really good question that unfortunately the insurance companies don't do a good job at answering. These policies are not unbundled. So it's hard to know exactly what the costs are. You just have to look at what the net return is when you look at the cash value. So you compare multiple companies and illustrations to kind of analyze that. And that's why it's important to have a certified cash flow banking specialist. So Garda is a company that is mentioned in this question. So two gentlemen, Ryan O'Shea and Dale Clark. Dale Clark became a client of mine in 2005. Ryan and O'Shea and I went to high school together, and he eventually became a registered investment advisor. And my firm Wealth Factory, we had Dale as one of our financial architects for a number of years, and Ryan O'Shea as an accredited network member, registered investment advisor to help our clients analyze their investments. Well, they came together and said, what if we created an insurance company and got certified so that we could be an approved vendor, like an accredited network member? And so they built that over years. And so I create content for them and license content to them. So I actually have a profitable relationship there, even though I don't have any ownership in the company and don't tell them what to do. But at the same time, for them to get those referrals and for those, for me to create content for them has to meet the criteria of how the policy design is. And so it's been a great relationship that way. And so Garda can write with multiple companies. They're not beholden to one. Like I know some people that are with good companies like Northwestern Mutual, but a lot of times Northwestern Mutual doesn't like them writing business outside of that. And so they're putting too many people in just one type of policy. And Northwestern Mutual also doesn't like for people to borrow from their policies. they tend to have a little bit of penalty on the commissions for the agents. So even though I would love to see that policy, I think it's a good policy for people, I don't run into it quite as often. Other companies that are really good out there, like Guardian, I have a policy with. Mass Mutual is another company. I think they've hit the $1 trillion mark now. Penn Mutual, Mutual Trust, Lafayette Life, New York Life, One America, just to name a few. There's, like I said, probably a couple dozen. Those are all mutual companies. They've got good track records for, dividends. They've got good guaranteed interest rate. They've got pretty good flexibility with the overfunding. So yeah, there's the answer to that. And unfortunately, they don't unbundle these and say, here's exactly what you're paying. You just have to look at what your net is. Like, what are you actually getting after expenses?
Okay. So when someone's starting out, because I'm assuming there are a lot of people who this is a new concept for, do you have any tips on what they should look for when they're navigating that new contract?
Well, I think that cashflowbanking.com is a phenomenal resource. I think on YouTube, we have so many videos. If you type in, my name and cashflow banking, that really goes through this. We've even built courses for this. Even in my book, budgetingsucks.com, I have whole chapters on cash flow banking and cool resources and even video courses that people could buy in addition to that to get more detail. But even What Would the Billionaires Do? Another book of mine goes into a ton of detail around this. Now, whether you want to invest and buy those books or whether you just want to navigate the YouTube channel, we've gone through a lot to help people
really
navigate this. Yeah.
I have one other clarifying question. So you said you prefer mutual over stock companies. And we know if it's a stock company, it's connected to the stock market, Wall Street. But tell us, just clarify, what does it mean if it's mutual?
Privately held.
Okay.
So it's not traded on the stock market. These still be really big companies, and they're owned by the policyholders. So when there's a distribution, it goes to whole life policyholders. Now, I don't use universal life policies for cash flow banking. A lot of people use index universal life, which is given a minimum guarantee and you get to participate in some upside in the stock market, but it has a variable cost ratio through what's called M&E. So mortality and expense can increase over time. And so I like to have that more stabilized and fixed with cash value and whole life, because you may want to utilize that more often and put it back in, and when good opportunities come. And so designing it right is really important. So yeah, we've covered my relationship with Garda, and we've covered a lot of the different, companies that you could use out there. But creating a certified cash flow banking, policy comes from cashflowbanking.com. And, another question that was in there though is, are there guarantees to these?
Yeah.
And so when you put your money in the bank, there's the FDIC, right? So that you've got that guarantee or that background. Well, there's state guarantee associations. And we're filming this in Utah right now, where that state association has never been tapped into for $1 when it comes to life insurance policies. The FDIC has been tapped into to the tune of billions of dollars. So looking at the stability here versus the stability of most banks are lending money too frequently. I mean, they do fractionalized where they can lend $1 more than once and those types of things.
Yeah. Okay. Let's see if we covered all of Justin's questions. Oh, are death benefits still guaranteed if they go out of business?
So death benefits right now, it's happened most of the time if a company's gone out of business, another one buys them. But then, yes, there are limitations to how guaranteed they are based upon the state association in which state you're in and how much they're willing to guarantee. But that does give you a little bit of a backdrop. And, once again, why it's important to have these multi-billion dollar companies that have seen different cycles, that have tons of cash reserves, and I feel can recruit the best talent because they've got the money.
Yeah.
I think it's a little bit harder on these startups, and we've seen how a lot of startups are kind of hit or miss. And this isn't really a sexy industry. This isn't like something overly exciting that a lot of new talent is getting into necessarily. So to see a startup try to enter this arena, I mean, it just seems a little bit too volatile.
Yeah. So we know on your YouTube channel that there are a lot of people who are starting off their journey of building their financial literacy. So if someone's learning about these policies for the first time, when is a good time for them to get started? How much can they start putting into it if they don't have a lot of money?
I started when I was 19 years old with $50 a month.
Okay. So
wasn't married, didn't have kids, just started somewhere, right? And then there's people that are putting, there's people doing private placement life insurance, which starts at $1 million minimum to put into it. So there's the whole gamut.
Okay, so this is a good place for people to put their money in all different
All right,
pieces
so
of
we've
life.
talked about mutual versus stock, old companies. We've talked about Garda and my relationship there, and a better system for you to capture your wealth, and then you can use the cash that's in there anytime and still have tax advantages along the way. One of the problems with cash flow banking or cash flow insurance is that there's a capitalization period. There's a time before you get to break even. There's costs up front, and those can be frustrating. So there are some things you can do. We'll let Chief of Staff Stolba ask the question, and I'll give some answers.
Yeah, it's a pretty straightforward and short question today, but it comes in from Chris, and he says, in regards to the cash flow banking, can a policy be jump started at the beginning with a lump sum and then monthly premiums thereafter?
Yeah, there's something called single premium life insurance. The problem is single premium immediately does something called MECing, MEC, modified endowment contract. Have you heard me talk about this before?
I haven't heard you talk
Look
about
at this.
MECing.
We're just going to teach
I'm
Stolba
learning right
while we
along
do this.
with everyone. Here we go.
So MEC means that it's going to be treated more like an annuity almost. Like you put so much money in it that corridor between your cash value and your death benefit has been crossed. See, in the late 70s, E.F. Hutton kind of really created universal life. And it was a way to take advantage of really high interest rates at the time. And they wanted to put it in insurance where there was this kind of tax benefit. Well, they would stuff so much cash in there, the government was kind of like, well, we need to put some type of limit on that. And that's the modified endowment contract. So if you do a one-time premium, it's probably going to be a modified endowment contract. But you can do a lump sum up to that level.
Okay.
And then there's something called PUA or paid up additions. Paid up additions.
Yep.
You can put extra cash above and beyond the base, the base policy. And that goes up to that modified endowment contract. But typically, if you max that out from day one, you're kind of paid up after 7 years. It's called a 7-pay test.
Okay.
Okay. So yeah, modified endowment contract. I once did this with one of my policies by putting in too much money. I hurried and took that money back out before it became official. And there's software that kind of looks after that. But the difference is when you put money into a cash value insurance policy, it's treated FIFO. Have you heard?
First in, first out.
Look at this. FIFO, first in, first out. The first dollars you put in premium are the first dollars you take out, which means there's no tax on them, right? Most things like an annuity are LIFO, last in, first out. The last dollars in are the first dollars out, and the last dollars in were the interest. So you have to pay tax by pulling that out. So FIFO is a good treatment. Modified endowment contract would now make it LIFO instead of FIFO. So you lose that advantage, right? Okay. So you want to fund it only up to that limit. When you borrow from your cash value, there's no tax on that, right? Because it's a loan from the insurance company. They let your money act as collateral. You still earn interest on that. Now, there's direct recognition or non-direct recognition. So we're getting in the weeds here for just a minute. Direct recognition is like, okay, we know that you have this loan out there, so we might change the interest rate that we pay you. So that could actually impact you and maybe even create a spread, right? Where you're paying a little bit more than you're earning. Or non-direct recognition is, oh, cool. We're going to act like nothing's going on and just keep it going the same.
Yeah.
I don't get too caught up on those details, but it's just important as we're looking at modified endowment contracts, we're looking at tax treatment like FIFO or LIFO, that when you're borrowing, it's against the cash value. So they're not paying taxes on that. If you don't pay it back, it's subtracted from the death benefit, which is income tax free. So these are all just the basics of how a life insurance policy works.
Yeah.
I personally like to overfund them. I like to set up PUA and put more that goes towards that cash value that can push the death benefit up faster in the future. And it can allow me to access cash faster with less commission. So all of a sudden I get to the break-even point a lot sooner. I was talking to Justin, who's a Wealth Factory member yesterday, and I was doing a podcast with him. He's like read everything that I put out there and he's loving everything. But, he was saying that his brother, who's an attorney, was like, I don't like whole life. And it like shocked him because he just did. He goes, why wouldn't he like it? I'm like, well, I first learned that whole life was a hole that you throw your money into. Doesn't sound like something to like, is it?
Absolutely not. Not referred to that way.
So I was like, but then I started looking how most of the policies are designed and the companies that design them. Most of them take so long, 10 years. Some are as bad as 20 years to break even. Can you imagine? Like you're going to do better in a savings account for crying out loud. So we have to find the right types of companies, which I prefer mutual companies that are owned by the policyholders versus stock companies, which are owned by the stockholders. So when there's a distribution, it just goes to the policyholders, not to the stockholders and the policyholders. That's one thing I look for.
That's a really good thing to know.
Right. The next thing I'm looking for is, what are their PUA provisions? Can I put a little bit in and put more in later, or is it fixed from the time that I start? That's another thing I'm going to consider. I'm looking at, multi-billion-dollar companies or $1 trillion company like MassMutual that I have a policy with. So I'm looking at those factors. So I want to see really early cash value, but I want to see long-term healthy performance. And I'm looking at kind of the mix between that. So I've got policies with MassMutual, with Guardian, with One America, also known as AUL, Emeritus, which I don't love them, but I have policies with them and they're old, so I just keep them. So I've got various policies, and Penn Mutual is the last company. So there's a couple dozen companies that you could do this right, but a lot of people haven't done it right. They're looking at policies from the 1950s that the death benefit didn't go up over time. So I think it's important to realize that whole life has a guaranteed premium that they can never ask for more, a guaranteed cash value that once it's there, it's yours, a guaranteed minimum interest rate that you're earning, right, and a guaranteed death benefit. There's people that have gravitated towards other policies like universal life policies, or, other hybrid policies like indexed universal life being probably the most popular today, that they can change the cost of insurance. And that cost of insurance can start eating away at your cash value, or not a non-payment can negate your guarantees. So it's important to kind of see what you really have. A lot of them work the same way as far as the loan provisions, and a lot of them work the same way as far as modified endowment contracts or lump sums that you could put up front to accelerate what's going on. But hopefully this gives people a little bit bigger idea of what's happening here without confusing them. Did it all make sense to you as a question, Stolba?
Well, I'm going to have to rewatch this video myself. I feel like that if someone's just starting out, I think there's a lot of terminology that you brought to the table that just even having an awareness about, they'll be able to go investigate more deeply before they have the conversations, be able to look at the contract with a little more insight and know that they're getting into, something that is a good fit for them. But it's just, don't be discouraged if this feels new and feels overwhelming. Like, rewatch the videos, listen to it multiple times. But just, I think people building up the vocabulary around financial literacy is really important, so they know what kinds of questions that they can ask when they go and they're researching these policies or trying to find the companies that they want to work with. As you were talking, one question that came to mind was when someone's looking for a company, you have A-rated companies and B-rated companies. What's really the difference in the nuance between an A rating and a B rating?
Look, I'd be heavily concerned with B ratings. It's usually the kind of companies I see there are more like term shops. They're really just trying to sell the cheapest policies possible. And you look at their finances, like anything less than the A ratings, which there's multiple A ratings. You got AM Best, Standard & Poor's, Moody's, right? You've got like 4 main rating companies when it's in the insurance industry, and you might have A++ or A-, or, there's different ratings for each one. And I think when you're in the B's, it's a little bit more concerning, especially if it's cash that you're storing there, as well as the death benefit. Yeah.
So is any A rating considered a good move, or is there one that's better than the other?
I mean, obviously, if you got like the perfect ratings, but some of these companies get marks because they sell disability insurance, and they might be facing more risk of claim on that, or maybe how they manage their portfolio. Maybe they have a little bit more in the stock market, which most of these general accounts don't have that much. So there's a lot of factors that go into it.
Yeah.
I used to understand it a lot deeper and more when I was in my 20s, and I researched this inside and out. And what I realized, especially after watching Big Short, is there's a lot of pressures on these rating agencies to give certain ratings. Otherwise they take there's this underlying kind of competition there that might not give us the accuracy that we're looking for. So you can only rely on those to a certain degree. But I'm saying if we're in, I don't care if it's B+, I want only A ratings across the board, even if it's A- here or there. I want to know maybe why that's happening. And I want to warn people against only looking at how illustrations perform, because I just see, policies that they show an interest rate that's fairly high as if it's going to be that every single year, and it's not. So they go, oh, I could have millions of dollars in this. That's what I was shown when I was 18 with the VUL. It's a variable universal life that's got separate accounts that are like mutual funds. And they showed me 18%, which is totally illegal. But the 90s was awesome. So there's like, oh, this could keep going forever. Then 12% is the top that they can show you, which is still a pipe dream because it's not the 90s anymore. And we haven't seen those kind of returns in the market. And what they should have showed me was 6 to 8%, which totally fundamentally changed because
That's a drastic
the insurance
difference.
costs eat up a lot of that, and it doesn't do nearly what it was supposed to do. So from going from being a multimillionaire to having something completely fail because it was all with baseline commission, which it was all commission premium versus overfunding. And I know that, some of these insurance agents don't want to overfund because they just want to get paid as much as they can. But I'd rather see them do what's right and get paid a little bit less and just help more people. How can you get your money to be more useful and keep it in motion? And how can you coordinate assets to get way more bang for your buck? Stova, let's answer it.
Those are all great questions. And it's inspired by Nehemiah's question.
Nice.
So Nehemiah, this is what he wrote in with.
How's your latte I made you?
Oh, it's great. I love it. Oat milk.
Oat milk latte. Hey, there's been a run on the oat milk I use. So I now found some and had to treat it like it was toilet paper in a pandemic. I now have a huge fridge just dedicated
Stockpile.
to the oat milk for my latte practice
I
here.
love it. I think the latte impaired my speech there for a second.
Well,
Okay.
I didn't put any Baileys in it.
It's not an Irish coffee.
No. All right.
Okay. Here's what we heard from Nehemiah. I'm considering withdrawing money from my active 401k. Right now, the potential plan is to take that money, which is about $50,000 after assumed tax, to create an overfunded whole life policy for both my wife and myself, and then withdraw as much of the immediately accessible cash value to pay off all remaining debts, and then fund our peace of mind account. The thought process here is to have interest growing on the entire $50,000 and pay that all back gradually with the income from our current jobs until we can eventually replace our incomes with investments. My wife isn't completely sold on cash flow banking because she's never heard of it, and she's of the opinion that if it isn't broke, then don't fix it. Or if it isn't broke, don't break it. With our current situation, how would you go about handling the 401k money, the debt payments, and the availability of cash? He says, thank you for your advice. I've read all your books and Kiyosaki's and others in the attempt to become financially mastermind sooner rather than later.
A financial mastermind or financially mastermind?
Financial mastermind.
Hey, I'm here to help you out today, still, but I know it's been a long week for you.
I need you today.
Yeah, you can lean on me. And you said I wouldn't be able to make you laugh. I've done pretty good so far.
Yeah.
So mostly at your own expense, but
Should
it's
we
fine.
make everybody else laugh and sing Lean on Me together?
So if it ain't broke, don't break it. Let me say this. That's what you said. If it ain't broke, don't break it.
That's what it says in the
Okay,
question.
well, I'm saying that's fine.
I'm telling you, that's why it threw me off.
The problem is 401ks are broke
Yes.
because your partner is the government. They're $27 trillion in debt.
And counting.
And you're not saving tax, you're deferring tax and delaying tax. And because of inflation, you're going to want a lot more money in the future. And because we've got someone here reading books and doing the work, he's going to be wealthier in the future. So don't just defer those taxes into the future and go, oh, now everything's fine. Because right now there is a provision where you can get that money out without the 10% penalty potentially because of COVID. But let's start to break this down. First is you're not just going to cash this out and put it all into cash flow banking because of the way cash flow banking works. There's modified endowment contracts, which you can only put a certain amount of money before you lose your tax benefit. But getting it out of the 401k still is an idea to maybe talk to an investment advisor and really look at. Most investment advisors are pro retirement plans because they get paid on them. I'm not really a big fan of them. Okay, but then he's saying go to an overfunded cash value policy first, and that could be a good idea, but here's the things to watch for. Number one, it takes a bit to capitalize. So let's just say you could put 50 grand in there. You're not going to have 50 grand in the plan because there are costs. Some might point that out as commission costs and all that kind of stuff. What it really is that the overall commission costs are kind of spread over time and paid directly from the company, but obviously they're profitable because of these plans. So there's reserve requirements that are there. There's those factors that kind of go into this. And so you're not going to have the full amount in there. So you got to look at that first and foremost. Then second, I like that he's talking about putting this money into cash value, then utilizing the cash value to pay off the loans. And if those loans are charging more than what you're earning in the policy, then do that, right? Because then you're paying that off. And then you can take the money that was going to the loans and pay back the policy. Because now you could do is you get your cash value, you get to use it as collateral. The insurance company will lend you money at a very preferred rate. and then you can pay that back on your own terms. It doesn't impact your credit, but you're going to free up that cash flow. And what's nice is your money's still in the cash value, earning interest during that time.
Sounds like a lovely thing.
So you're earning interest during that time. Yes, you're paying interest to the insurance company for lending you the money, but at the same time, this is going to be on your schedule now. You can decide how much you pay into it, how much you don't pay into it, where the other, loans are fixed prices. And a lot of loans right now are pretty competitive interest rates. So we also want to look at that. Mortgages are at pretty much like an all-time low as we're recording this.
Yeah.
Even car loans are very inexpensive if you have the right credit. But I do like the way that he's thinking, because I look at this as money in motion. So I have my cash value policies, right? I put extra money into those policies. And early on in my life, I used to use the cash value to make down payments on real estate. Then I would get the real estate. I would take the rents from the real estate to pay back the cash value.
Yeah.
And then one time I started to use that cash to do hard money lending, which is I was actually a bridge financer. Like, someone would find an awesome deal on a property and they'd need to act quickly. So I would charge them a bunch of money, like 10%, right, for having this money for 60 days. So, it's a pretty good rate of return when you think it's really more like a 60% rate of return annualized. So I was getting a really good return, but I was giving them access to cash they didn't otherwise have. And then when that money would come back in, again, I'd be buying property and paying down payments and using the renters to pay that back and then buy more property. So it was kind of the keeping money in motion. And I like that
quick
thought process.
Turnover.
Because he's not just thinking about setting it and forgetting it and just waiting for 30 years hoping it's going to pan out. He's recognizing, hey, I can start building this cash reserve that I can use when there's good things to invest in. But right now, the best thing to invest in might be paying off those loans, freeing up the mind, the mindset and all that kind of stuff. And, not doing the retirement plan, kind of a good idea.
I know this might be a little bit difficult to answer, but when someone's taking money out of their policy, what is the interest rate on that versus what they would get if they had a loan at a bank? Like, is it drastically lower, or?
It depends on the person.
Okay.
So I was speaking at an event a couple years ago, and there was a guy that does a lot of life insurance, loves my books. And he came up and he's like, hey, we actually have a deal right now where Bank of America is using the cash value as collateral rather than the insurance company. And they're only charging 2.75%. And that was when interest rates were a little bit higher. So that might make more sense, because some insurance companies might be charging 5% right now. And 5%, for a collateralized loan isn't a great deal. It's a great deal during other times, because a lot of times when interest rates are really high, which they haven't been for a long time, you're getting a much more preferred rate from the insurance company than you would out there in the marketplace. In today's time, though, interest rates are so low out there that if you have the right credit, the right collateral, you might be able to get a better deal from a bank, but you're now using your credit. You're now on the bank's payback period. You have more restrictions. You're jumping through more hoops versus just filling out a form or making a phone call and getting the money sent to you.
Yeah.
So you got to look at the ease, the convenience, and the quickness of just using it from the insurance company standpoint. But I like your question to look at what makes more sense,
Yeah.
All right, let's talk,
So when you were talking about money in motion, you were referring to velocity.
Yeah. So
Or is there more to that piece of the conversation?
So to define velocity versus accumulation, this is something I learned in my early 20s. It's kind of like an economic concept, velocity is, and it's how the economy's measured, or how it works a lot of times is we take the output of an economy, which is the GDP, gross domestic product, divided by M2, which is the money supply. So simply it's just output divided by inputs, right?
Okay.
So
Simple enough.
So, and what it does is it tells us a number, and that number is how many times did money exchange hands that year? The more frequently, the higher the velocity, right? Because if I buy something from you, it's not the end of that money. You get to take and use it again, and then someone else uses it. So, this whole notion that there's a finite pie, I wrote about it in my first chapter of Killing Sacred Cows.
Yeah.
Well, people think money and pie are the same thing. They're not. Even if there was a finite amount of money, they're printing it while I say this or adding it to screens.
Yep.
There's an unlimited number of times it can exchange hands. So the more frequently it exchanges hands because of goods, services, and experiences of solving problems, serving people, and delivering value, the more wealth is created. So exchange actually creates wealth. And so the more velocity that we can create, the more wealth. So how does this apply on a personal level? Well, there's the Stolva output divided by input. So if I tell you to take more risk, that's an input. That doesn't help you out. If I tell you to add more money, well, that's an input. That doesn't necessarily increase your velocity, right? And that's where a lot of people are at their finances is, oh, take more risk or set more money aside. So what we focus on is how do we keep the inputs fixed, but increase output through velocity.
Okay.
So there's two main focuses for velocity. One is efficiency. If something's more efficient, it's going to, travel further essentially.
Yeah. And this is when you would encourage someone to look at their insurance policies,
Yeah. Is there duplicate coverages or
interest
costs?
rates on their credit cards.
Can they renegotiate or lower their interest rates? Are they overpaying on tax? Are there hidden fees or commissions in their, investment plans? So we're just finding money. That's part of the efficiency. So that intelligence or that knowledge increases the output without you putting more input in. It's through savvy. The second thing is expansion. So expansion can be scale. It could be motion. And so if I've got, let's say $100,000 that is now kicking off cash flow for me. When I first did this, I had $100,000 that I was doing hard money lending with, which was consistently getting me 1% per month. So I'm getting $1,000 a month. I was taking that $1,000, I was putting it into my cash value, right? Then that cash value was growing, and then I was buying property. That property would appreciate. I would refinance. I'd put more money in hard money lending. And so all of a sudden, I'm getting more turns on my money. I'm getting the interest from the first investment. I'm buying real estate. I'm getting tax benefits. I'm getting cash flow. I'm getting appreciation. As it appreciates and I refinance, I'm putting more money in the front end hard money lending fund. And so I'm keeping money in motion. I'm not trying to utilize accumulation, which is all about, okay, if I want to be having more money in the future in accumulation, it's how much money can I put away, right? That's the budgeting, takes money to make money kind of thought process. And then it's how do I get a better return, which most people think to get a better return, they take more risk, but risk equals a higher chance of loss.
Yeah.
And then the third thing is, it's all about how long can I wait? Compound interest will come in and save me. The problem is accumulation is a slow, tedious, dangerous process.
Is that because your money's stagnant?
It's
just
very
sitting there,
stagnant,
right?
Compound interest doesn't look good in the first 5 years or 10 years. It looks good in the 20th and 30th year. And then there's a lot of things that can trip you up along the way, financial disasters or concerns or financial crises or collapses, or there's just so many things that happen along the way. And I think that all institutions, especially banks, are going, we want cash flow, yet they're telling you, you want to accumulate. Well, they get cash flow. So
different story.
So I think cash flow investing is really a completely different methodology that's a much more impactful, it's safer, but it requires more effort. It requires more knowledge. It requires, participation. It requires like doing something instead of just handing things over. So I like having cash value because if I don't know where to invest in the moment because I don't think it's a good time, or I just want to take a break and I just want to, have a sabbatical where I'm writing and I'm not focused on those things. I know I'm storing my money in a place that's protected on the downside, not participating in a recession, getting a guaranteed interest rate once it's paid. A dividend becomes guaranteed once that enters the plan, and it's available to me along the way. So where people dislike it is because so much of it's designed poorly. It's high commission, low cash. It's with these companies that weren't really designed to offer these types of plans, or people that skip steps and take more risk by moving to index type things that have volatility within their fee system or within their expenses. And so it deserves some of the bad reputation it gets. But if people, as he says, his wife has never heard of it. Yeah, there's a lot of things that people probably haven't heard of with finance. Like they probably never heard of private placement life insurance. They probably never heard of premium financing. They probably never heard of charitable remainder trust. They probably never heard of a Section 1202 for selling a business. But these are the things that the wealthy people have been doing for an extraordinary long period of time that didn't trickle down to the middle class. When I wrote What Would Billionaires Do, I was like, how do I take something that the wealthiest people do and find a way to design it for anyone, even if they just have $50 a month, and make sure it's available. It's not identical, but I at least took the main concepts to provide that benefit, because unfortunately, if you're super wealthy, you can get stuff without commission, right? Or you can have it specialty designed and you can have it more cash heavy because of the way that it's built. But there are ways to at least mimic that to a certain degree. So the lesson here is money in motion and velocity over accumulation. And that I like the way that he's thinking, and have a read What Would Billionaires Do? They can go to billionairesmethod.com, and it's super inexpensive. I think it's a few bucks to grab that book in PDF or listen to the audio.
Yeah. So if they don't have the policies that you're referring to and have that situation with the real estate to keep that you were using to keep your money in motion. If someone's a W-2 employee or they're just getting started out, what's one thing that they can do to keep their money in motion? Because it's not just about going to Target and, buying some things, right? Can we expand that for the person who doesn't have these
policies? All right, so here's what you do. You've got to start with building savings. Not investing. People call their 401k a savings plan. It's an investment plan.
Yeah.
Savings is available, liquid, safe. It probably isn't earning much money. Don't worry about earning the money. Have that there so you have peace of mind. As soon as you have a little bit of money there, now you can go, and here's the velocity for you. You can go change your deductibles on your car and your home, or your elimination period on your disability policy, or you can start to drop coverages because you've got the ability to handle the small things, which can save you a bunch of money.
Okay.
There's the first step. And then you can start looking at, well, where else can I create velocity? Well, if you're buying term insurance and investing into your retirement plan, it looks good on paper in the immediate moment, because when you get that retirement plan statement, it looks like, oh, I've got $10,000 in here. No, you don't. You've got $10,000 that the government still has a right to take their fair share of. And fair is a pretty,
what
nominal
is fair
word.
when it comes to the government?
I'm using their terminology, not
Right.
mine. And so when you go to pull that out, they're taking tax and potentially even penalty based upon when you take it out. So it looks good on paper, but it doesn't deliver in reality because of the net of expenses and fees and taxes. And then you still have this term insurance that eventually becomes so expensive that if you live to life expectancy, you'll pay more for term insurance premiums than the death benefit, because it's cheap when you're not going to die.
Right.
It's super cheap. But
cheap
it's
when you don't need it.
expensive when you don't have it. Where here's the deal, we're all going to die. And even if Ray Kurzweil figures out how to upload our consciousness to a computer, the bottom line is when you're 100 or 120, depending on the type of policy, they consider a living death and pay out the death benefit. So why, when we know we're going to die for sure, would we drop insurance at the time that we have the likelihood of death? It makes no sense, but it's because people are measuring the wrong metrics. They don't understand how to look at this. And so if you actually can move to an overfunded cash value, you're going to get some velocity because you're going to save on term insurance premiums.
Okay.
You're going to save on taxes, not just temporarily, but there's ways to permanently save, unlike the deferral of a retirement plan. You might be able to save on long-term care insurance because there's riders that allow you to access your death benefit if you need long-term care, which might create, once again, another benefit there. And that money's available to you. So if you have to pay off high interest rate loans, it's available. Versus it might not be as available inside of a retirement plan because there's restrictions on how much you can take out, and there's restrictions on how you have to pay it back. Let's see what the banks and big corporations do to store their money tax efficiently and safely, and how you can do this if you have a business or not, and how to handle it if you have both. What will happen as the dollar devalues if you're using the strategy of cash flow banking? What things should you be aware of and consider? All right, Stolba. We were in the middle of recording this and had a full-on power outage.
I know.
So here we go again.
Round 2.
Freaky. You were worried about it, huh? It's daylight outside.
Well, it's dark in here.
Pants and I would have protected you, Drew's over
thanks.
there. Yeah, Phoenix didn't even get excited. My dog's in here.
I know.
Yep.
So the question we have today comes from Nate.
I think you want to give a little shout out here.
Oh, yeah, we do. So Aaron is the third member of the Wealth Labs team, and his mom made these mugs for us. So shout out to her.
Lafayette, Indiana. There you go.
Midwest. Okay, so Nate's question. He says, I'm sure this question is going to be fun for you guys to nerd out on. You're going to be the nerdiest of the two of us. When were you the most nerdy in your life? Is it now? Or when you were?
Yeah, well, definitely to my 15-year-old. Although he thinks that my wife is creeping up to becoming more embarrassing. She's never embarrassed him before. So yeah, definitely. I'm probably most nerdy now. I'm just so comfortable with who I am.
It doesn't even matter.
Whatever.
We all have foibles and nerding characteristics about ourselves.
I still get nervous.
I feel nerdy.
When I went to the archery place for the first time, I felt these nerves. Like, I don't even know what I'm doing, and what if I don't shoot well?
It's kind of like the junior high dance where you feel a little awkward.
And now I'm homies over there. Walk in, they know
Give
my
them a
name,
fist
and
pump.
we hang out. And
High
when I shoot a
five.
bad shot, we laugh about it.
I love it. Let's see. I feel like I'm still nerdy, but maybe when I looked the nerdiest and was more socially awkward was probably 7th or 8th grade. I can see the school picture, the lifetime school picture in my mind. It was.
Do you still have a copy of it?
Oh yeah. My mom has
We need
everything.
to see it. We need to see it.
Okay. I'll get the picture. I don't know. Oh, this it's so nerdy.
There's a picture in my wedding video of Carrie standing next to this motorcycle, and whatever hat she's wearing, she looks like a boy. I thought it was a picture of me, and I'm like, I don't remember doing that. And I'm like, oh, that's Carrie. Like, it's as nerdy as it gets.
Yeah, I just remember, like, I felt good. I had a new shirt on. It was a button up, but it was a polo, like, so basic. School picture day, so I curled my hair, you know. And I walked into Mr. Copeland's art class. He was my favorite art teacher of all time. And he complimented me. And I was like, well, I'm just feeling like $1 million today. But the picture speaks otherwise. I look so insecure. I have these huge glasses. I'm just so
Why'd you get rid of the
awkward.
glasses? I feel like you should be bringing those back in style.
I wear glasses on a regular basis.
Like when you're trying to
but
look
not
smart.
the ones that I wore in junior high.
You know the picture of me with glasses, the fake glasses?
Yeah, mine were real.
I was like in
actually
my
needed
early
them.
20s pretending that I was smarter than I was. I want to be your financial advisor. So
Trust
ridiculous.
this guy. No.
That's the one where I have the goatee.
Oh, yeah, on the DVD case.
Yeah.
Do you remember? Yeah. We got to show a picture of that. I'll show
You know it's good when it's a DVD case.
That's true. It's hanging on the wall for everyone to see. We're going to put it in the video so you can see.
We love making fun of me. It's fine.
I'll see if my mom can get me a copy of that picture, and then I'll look at it and see if I want to put it in the video or not.
All
Okay,
right.
but you ready to
Let's
nerd
not
out?
kick the power. Let's get through this video this time.
We don't want to do round 3. Okay. Here's Nate's question. He says, I'm looking to build my real estate business to a Fortune 500 within my lifetime. I want to build my family legacy along this business. How should I set up my business structure where the business and my family can benefit from cash flow banking? Do these things have to be separate? And what he's referring to is ensuring the business, himself, his wife, his daughter, and his employees. So let's start there, and then we'll go into the second part of his question.
Yeah. So, look, banks hold a part of their reserves in bank-owned life insurance. So their policies on these executives that are high in cash value. Corporations do the same with their executives. You can see it on a K-1 form if you want to see where the premiums are going.
Okay.
And there's bank-owned life insurance, there's corporate-owned life insurance. And so I really recommend you begin personally and maximize your personal coverage first.
Okay.
Overfund that properly. Even insurance on spouse and kids, because we're thinking about legacy. Then worry about the business second.
Okay.
Now there's some advanced strategies. Since he's going to be a Fortune 500, he'll want to look into private placement life insurance, which usually have to have $1 million a year minimum to get into that. So not a very
big
common
chunk
thing.
of change, yeah.
Or even premium financing,
Okay.
where banks or big institutions will pay your insurance premiums if it's a cash value heavy enough policy.
Wow.
So they finance it just like they might finance a home. I actually have one of those policies myself.
Woo woo.
On my wife, not even on me.
She is the gem.
Oh, wow. I
are
agree. I
too,
like her.
Gunderson.
I like her. So I was thinking, like, we've been married for 18 years, and it's still so new and fresh because we've changed so much from the time that we were little pups when we got married.
But isn't that exciting? Isn't that what makes marriage so fun, is that you're always evolving and it's a new adventure?
I literally tell her almost every night, you want to stay the night? Are you sleeping over?
You want to have a slumber party pillow talk?
Makes me think of like the show Big.
Oh, I do love that show.
So you got corporate-owned life insurance, bank-owned life insurance, and personal. You want to do, like, I'm a partial to overfunded whole life policies.
Yeah.
So that has more cash value fueling it and less commission.
Okay.
It grows the death benefit. It gets paid up over a certain period of time. You have access to cash along the way. So maximize it on a personal level. I've got my personal policies, several on me, some on my wife, and on my kids. And then we did the premium financing later.
Okay.
And then we got the corporate policies later.
Okay. So number one, Nate should insure himself, then go to his wife, and then his kids. But what about his business and employees? Where do they come into this?
Well, I have some policies from the past on employees. I didn't get one on you, Stelba. I just figured, like, you're too stubborn. You probably wouldn't even let me do it. You'd be like, well, I want you making money if I die.
Hey, why not? Take the money. You'll do good with it.
But you can definitely do this for employees, and you could be the owner, because there's the owner, the insured, and the beneficiary, right? The owner can change over time. You can choose to give up that ownership or transfer it, like, to your kids. The insured's the one that always stays the same. And the beneficiary could change. It's who the money's going to go to. Could it go to a trust, to an individual, to a corporation? And so, ultimately, I own policies within an asset protection trust right now. and that can keep them out of my estate so I don't have an estate tax when I die, but it still give me access to the cash through something called the distribution trustee. Okay. So it's kind of like owning nothing, but still controlling it. So
Which
it's
is a
great
great
for
place to
asset
be, right?
protection. Right. So, I've got policies on each of my kids. I can get however much on them has to do with how much I have on me and my wife. And my wife still has one term policy because we have a lot of whole life and the premium financing, but we just kept this one smaller term policy. And, I have all whole life and then the kids are whole life. So there's key man policies that you can get when you have key executives, and those could be buying that person out if they die. So the money goes to the family, not the business, right? There's different kinds, cross purchase or
So
stock redemption.
This is a little bit off track here, but when companies are saying like, okay, we're letting go of the CEO or, for whatever reason, and then they get this gigantic bonus, even though they didn't, scale the company or they didn't meet the goals. Like,
The golden
is it because
parachute.
they had insurance out on the CEO, the CFO, or is that
No, because the reality is they didn't die.
true? Yeah. Good point.
They likely had insurance because almost every major corporation gets key man insurance because it's a major loss when you lose that human capital to the bottom line of the company. So you'll have those key man policies.
I guess
quite
I'm
often.
always wondering like how these people, CEOs, CFOs, whoever, they
You've
are.
done a terrible job. Here's your money
Yeah,
on the
like
way
you
out.
haven't met the goals. You dehumanized your employees,
Remember
and you're going to
AIG?
walk away with $60 million bonus.
72 people got $1 million bonuses after AIG had a massive cash infusion from the government after getting caught up in derivatives.
That feels so wrong
Yeah,
to me.
it is.
It feels very unethical.
Yeah.
All right.
So there we go. Inspiring people.
One question at a time. Okay, so we go into the second part of his question?
Yeah, let's
or do
go
you
to the
have more
second
to say
part.
on
No,
that?
go ahead.
Okay, so here's where you were touching on it with the overfunded whole life policy. But he says, also, can I treat my overfunded policy like a line of credit to pay down properties acquired on creative financing to capture interest?
Yes.
To lend from, to live on. How can he use the funds?
Yes, he could do that.
All of the above.
Yep, you could take a withdrawal from the cash.
Yep.
I don't recommend that. It's treated FIFO, first in, first out.
Is
So
there
all the
a penalty on that?
Nope. You put money in. Whatever money you pull out first is the first money you put in. So there's no tax until you've pulled out all the money you put in. Then it goes to your interest.
Okay.
But if you withdraw, it's hard to sometimes get money back in there. So the other option is you could borrow, but you're not borrowing like in traditional sense. You could go get a line of credit at another institution, and because there's collateral with cash, you might get a good interest rate. Some people do that. Or you could borrow from the insurance company. The insurance company says, hey, we'll use your money as collateral. We'll let it continue to earn interest. We're going to charge you an interest rate with that money as collateral. So a lot of times that's a wash.
Okay.
And so you can do that. You pay it back. If you don't pay it back, it comes out of your death benefit.
All right.
So yes, yes, and yes on those questions.
I love hearing yeses. Especially on things like this.
Cashflowbanking.com. Cashflowbanking.com.
Yeah.
Are
It's a great
politicians
resource.
corrupt? Yes.
Ooh. Yes.
Yes.
Okay. Lastly, this is the third part of his question. Lastly, as I build my credit limits, can I park cash from a line of credit or even alternative currencies like Bitcoin into a policy and keep it moving to bolster my cash value to protect from possible issues with the US dollar, or is that dangerous?
You can do it with private placement life insurance, where I saw someone fund that once with a racehorse. It didn't work out for them.
Okay.
But there's a lot more flexibility there. If you're with a mutual company, you're typically limited to the general fund and the cash value that's in there, but you could always utilize that cash to capitalize or invest in other things like we talked about.
Okay.
But you're not going to be able to, with most of those companies, the main majority actually have it in any different denomination, currency, whatever it is. So more of like the private placement, if you have substantial enough wealth where you could do some of those things. Now, are those things risky? Absolutely, unless you know exactly what the hell you're doing. I don't do them.
Okay. How much money does it require for someone to obtain like private placement?
$1 million a year is the lowest I've heard.
The lowest. Okay.
Yeah.
That is a big chunk
But
of change.
cash flow banking, $50 a month is the lowest I've seen.
Yeah.
That's how I started. $50 a month, Stelba.
It's Kaysen's question.
Yeah.
One of the things I want to ask you before we get to his question is, we've talked about 401ks, 401bs, and how those numbers and letters are codes within the tax plan. Today, we have a new one that we haven't really talked about on Ask the Money Nerds. It's a 457.
Yeah.
So do you want to tell us what a 457 plan is, and then we can get into Kaysen's question?
I mean, you don't see them very often. It's basic. It's not that much different than a 401k. It's a retirement plan that you can put money into. You know, you might hear 403bs, which are also known as thrift savings plans, 457s. These are just, they're all related with different nuances.
They're all forms of retirement plans.
Right. You don't see a lot of 457s. So.
Okay.
Yeah.
All right. So here's Here's what Kaysen is wondering. I recently pulled my 401k and 457 from previous jobs. I'm employed as a firefighter and have a small construction company on the side.
Cool.
With the retirement accounts, I have enough to build a duplex on a property we currently own. In a year, when I finish, I would like to set up cash flow banking, but have encountered a problem. I'm 39 and a year ago had melanoma skin cancer removed. The two companies I've spoken with, Northwest Mutual and Mass Mutual, will not insure me because of the superficial skin cancer. Are there any companies you recommend that would take me on with this? Yeah, this is, a conversation about pre-existing conditions.
Yeah, so one is if you can get an insurance broker that can write with multiple companies, and there's actually companies that specifically deal with people that are rated, or they get like a lower rating on a policy or denied on a policy. And yeah, certain companies, if it's smaller amounts, might be more apt to do it than others. Once you hit a certain amount, it gets to reinsurance, and it's kind of like, doesn't really matter who you're with. It's all kind of the same rules, but under a certain amount, some companies that's $1 million death benefit. Others, it might be 5. Maybe the high would be 10 million. But look, I've had these insurance brokers get me better ratings because I have some cysts on my kidneys, and they got me better ratings. So, cashflowbanking.com, see if they can schedule an appointment, see if they can get you with a broker. The other thing you can consider is putting the policies on someone else. So whether you have a spouse or whether you have kids, obviously, if you're the main one making money, you want to protect that income and have the death benefit there. But that's also another option, so that you're not just kind of stuck. When we were having a hard time getting the rating that I wanted, we put some more on my wife and kind of started funding her policies. So that's another option.
Okay. Now, how common is it for insurance companies to say, like, we're not going to actually give you a policy because of this superficial thing? I think it's pretty common, but can they just deny you altogether, or they just give you a lower
They don't see
amount?
that as superficial, obviously, right? I mean, they have ratings for people who are in remission from cancer. They might have a time period before they're willing to reissue or give a policy, where it's been in remission for a certain period of time. Certain heart issues, there's, each company has a little bit of nuance, and there's a lot of insurance companies out there. But I would say, make sure if you're going to go with this overfunded cash value, you stay with a mutual company. It's got to be worth billions and billions of dollars. You want only A ratings. I mean, A- is okay or whatever. You want them to be around for 100 years. You want a minimum guarantee of 4%. You want to make sure they've always pretty much paid dividends. You want that criteria. And then just see if someone can help you out. Like I've worked with a company that they actually had a doctor on staff, and then they worked with what was going on and how to present it and get the details and go through some initial testing, and then going and testing out who would actually go, okay, we're willing to consider this. And that's how we found the right company to do it for me. So check with cashflowbanking.com, schedule an appointment, tell them the situation, and see if they can get you with someone that can kind of help out.
Now, what about a wait period? You had mentioned like taking some time before reapplying.
Yeah, and this is why I like doing kind of the check in before you actually do the full application, where they kind of like test it out, and go, okay, is there, what would you do so that you're not being shown as being denied, right? Because that could actually be detrimental. Because now when you go to apply, it's like, oh, this person got denied.
Yeah.
Then other companies might follow suit. So after a certain period of time since you've applied, it might be 2 years. It depends. Some things are 2 years, some things are 5 years, where it's no longer, where that's no longer an issue, right? Because it's been far enough removed from the time, and then you're cleared on it. But yeah, unfortunately, some of these things is just kind of the way it goes. But I do think there's some possibilities if it truly is superficial, and some companies are going to be more sensitive than others. But you might have this mark if you have that denial.
Yeah.
What else do we have on here? Any other items to cover that I've put on here?
Converting term insurance, if you have it.
So sometimes if you have term insurance, even if it's not with the company you want, sometimes other companies will give you a policy based upon how much term you have. and you can convert over to them. That happens sometimes. Or if you're with the right company, you can convert that term into whole life regardless of your health. A lot of them have conversion options. So that's also kind of nice if that's possible.
I didn't know that. I learned something new right now.
Yeah, so I bought term insurance policies before and then converted them when my cash flow improved later on, or maybe I was in the middle of so many things I was worried about being able to do that. We bought term on my wife first when we were maximizing some of my whole life policies, and then we converted that term later on. So yeah, you can totally get convertible term.
Okay, so if Kason is in a period where he has to wait 2 to 5 years before reapplying, or he, goes to cash flow banking and they're not able to find a company that will insure him, he could start with purchasing term insurance if he doesn't.
Well, term
have
is
it.
just as likely to get denied.
Oh, okay.
If you already have the term, you can convert it.
Okay.
But to get the term, it might actually be harder to get the term with an issue than it might whole life. Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.